What if I told you that trading success isn't about making the biggest gains, but about avoiding the biggest losses? Yes, risk management. It's the secret sauce that separates profitable traders from those who blow up their accounts. Picture this. A trader enters the market full of confidence, makes a few wins, and suddenly believes they're invincible. But one poor decision, one uncalculated risk, and their entire capital vanishes. That's the harsh reality of poor risk management. It doesn't just dent your wallet, it crushes your confidence and derails your trading journey. Now, this video isn't about telling you what's obvious, it's about showing you the common risk management mistakes traders make and how to avoid them. Your number one job as a trader isn't to win big, it's to protect your capital. Now let's dive into the 4 biggest risk management mistakes you need to stop making right now if you want to become a consistently profitable trader. Mistake number 1, not having a trading plan. Trading without a plan is like driving in the dark without headlights. You might get somewhere, but chances are it'll be a crash site. A trading plan gives you clear entry and exit rules and gives you clear risk management rules as well. Without it, emotions take the wheel. One minute you're chasing a breakout, the next you're panicking and exiting the trade at the worst possible moment. Here's the fix. Write down your plan, decide your risk per trade, your profit targets, and most importantly, your stop losses. I'll use myself as an example. I spent a full year developing my Renko scalping strategy. I spent December 2023 to December 2024 backtesting, forward testing, analyzing data, and I've pretty much finalized my strategy. Finally, something I built from scratch over the course of a year. Does my trading plan have clear entry rules? Yes. Unless I make mistakes, because mistakes do happen, I only enter trades based on my strategy's rules. Does my trading plan have clear exit rules? Yes. Each trade has a stop loss and a take profit of 18 ticks or 4.5 points. And when price is 1 tick away from hitting my take profit, my stop loss automatically moves to break even just in case the market decides to reverse right before my take profit is hit. Does my trading plan have clear risk management rules? Well, during the development stage, I use 1 full E-mini contract per trade, which is a risk of about $94. But I plan to risk 1 E-mini contract per $1,000 in drawdown or total profit in an account in the future. Now it's time for you to do the same. Create your trading plan and most importantly, stick to it. The beauty of a trading plan is that it removes the guesswork and builds discipline, which is key to long-term consistency. Mistake number 2, overtrading. Overtrading is the silent killer of trading accounts. Here's how it happens. You've had a loss and you're desperate to make it back, or maybe you've had a win and you're feeling unstoppable. Either way, you're entering trades left and right without rhyme or reason. Overtrading doesn't just drain your capital, it drains your mental energy. The more positions you take, the harder it is to track them all, and let's be real. No one makes their best decisions when they're overwhelmed. I mean, think about the last time you went on tilt. All logic just goes out the window, and once you've had time to reflect, you feel absolutely drained. So what's the solution? Try setting a trading frequency. Maybe it's 1 trade a day or 3 trades a week. Maybe it's only trading within a specific time window. Find what works for you and your strategy and stick to it. Remember, quality beats quantity every single time. Mistake number 3, ignoring stop losses. Stop losses, the ultimate safety net that so many traders refuse to use. Why? Because admitting you're wrong is hard. That's why so many of you DCA into oblivion. You rather hold on, hoping the market will turn in your favor. But guess what? Hope is not a strategy. Stop losses are there to protect your capital when the market moves against you. They're not a sign of failure, they're a sign of discipline. To set effective stop losses, look at key levels of support or resistance, supply or demand zones, swing points, or whatever other market indicator you use to determine when the trade is invalidated. Trust the process and let the stop loss do its job. Mistake number 4, over-leveraging. Over-leveraging is the ultimate recipe for disaster, the ultimate confidence killer. I mean, it's tempting, right? You see these influencers posting these huge P&L days. You marry the idea of turning a small account into a fortune with just a few trades. You're trying to hurry and pass your prop firm evals in 1 or 2 days. You're rushing to reach payout thresholds in your funded accounts. But here's the truth. Over-leveraging is like playing with fire. It might warm you up at first, but it'll burn you eventually. The reality is, bigger bets do not mean bigger wins. They actually mean bigger risks. And when you're over-leveraged, even a small market movement against you can wipe out your entire account. So what's the solution? Risk the same amount on every trade. You can either risk a set percentage of your available drawdown, a set percentage of the profit in your account, or a fixed dollar amount. And if you really want to improve in the risk management department, consider using the Kelly Criterion formula to calculate your optimal risk based on your strategy's edge. Most of you have probably never heard of the Kelly Criterion formula. It's a formula invented by J.L. Kelly Jr. in 1956 that determines the optimal risk per trade for a trading strategy or betting system with a positive edge. Here's how to use it. FX Helpline has a free Kelly Criterion calculator available for use on their website. I'm going to leave the link down in the description box and in the pinned comment of this video. To start off, you enter your strategy's win rate. Do not guess it. Be precise. In this example, I'll enter a 65% win rate. Next, you'll enter the reward per dollar risk. For example, if you strictly follow a 2-to-1 reward to risk ratio, then enter the number 2. Despite the advice of so-called educational services, it's not mathematically necessary for this number to be greater than 1 in order to be profitable, but the proportion between this and your win rate does need to be balanced so that the expectancy is positive. Since the reward for my strategy is $86.02 and the risk is $93.98, my reward per dollar risk is 0.91, so we'll enter that. Next, hit the calculate button. Now you have 3 Kelly fraction choices: quarter Kelly, half Kelly, and full Kelly. I personally suggest using the quarter Kelly for low risk personal accounts, half Kelly for prop firm funded accounts unless you feel the need to go lower risk, and half Kelly or full Kelly for prop firm evals. This is key because it allows you to pass your evals in a shorter period of time without having to completely gamble them on news. In this example, the formula suggests that I risk 13% of my available drawdown or profit in my account if I wanted to use the half Kelly formula on my funded account. If my funded account has $2,500 of available drawdown or profit, I'd be risking about $325 per trade. No matter which method you use to determine your risk per trade, choose a risk and stick to it. And most importantly, resist the urge to bet it all. Your daily loss limit is not your stop loss. Trading is a marathon, not a sprint. So there you have it, the 4 biggest risk management mistakes traders make and how to avoid them. Risk management isn't just a set of rules, it's a mindset. It's about protecting your capital, staying in the game, and positioning yourself for long-term success. Remember, the markets are unpredictable, but your response doesn't have to be. If you found this video helpful, hit that like button, share it with your fellow traders, and subscribe for more insights to help you level up your trading game. Thanks for watching, and as always, trade smart. I'll see you in the next video.